our view is that we're likely going to get a hybrid of the bad and the ugly. We've had such a strong bull and business market cycle. The autumn and winter season is long overdue. We want to make money and we want to manage risk as best as we can, both as much as possible, but definitely not to be blindsided by the risk side, particularly in a strong market.
Hi, and welcome to Wealthion. I'm James Conner. Well, 2024 is coming to an end. I cannot believe it. And 2025 is just around the corner. And if you want to start the year off right, consider having a discussion with a vetted financial advisor at wealthion.com/free. Once again, that's wealthion.com/free to find out more information. Now onto the show. Ron, thank you very much for joining us today. How are things in London?
All good. Focusing on the markets as we wrap up into year-end, post-election, and certainly looking out to 2025 in terms of what next.
Yes, it's hard to believe there's only a month left in the year. But for those who aren't familiar with you and your firm, why don't you provide us with a brief overview?
Yes. Well, RW Advisory essentially focuses on research advisory, portfolio guidance, and external consultancy. The approach is global macro, semi-discretionary, anchored in behavioral tactical analysis driven by cycles and proprietary market timing overlays, using a blend of qualitative and quantitative models. And that's what we see on our opening visual, the blend of macro, fundamental, and tactical, looking at all three together where there's convergence, but then equally looking at potential leads, lags, and divergence as part of the market story.
And you also touched on behavior. And as we both know, a big part of the financial markets and the movements that we see on a day-to-day basis is all driven by psychology.
Yes, absolutely. I mean, people drive markets and emotions drive people. So they really do work hand in hand. We feed that through as part of the focus on differentiated alpha capture, insightful idea generation, but often non-consensus views, which are grounded within the behavioral approach, but also as part of a cross-asset portfolio overlay. And certainly the behavioral sentiment piece is what's key. It's keeps us on track as well as accountable to the changes in markets.
So these financial markets, and I'm going to start with the S&P, it's like a runaway train. It doesn't matter what you look at, like so many stocks, Bitcoin, so many other asset classes. They're just making new highs every other day. The S&P is at or near 6,000. It's up 25% on the year. And why don't we just start here with the U.S. market? So what are your views of the U.S. market? Do you think it continues to go higher into the new year?
Yes, for now. The market remains euphoric post-election. However, the view on risk proxies, S&P 500 case in point, is buy the rumor, sell or fade the fact vis-a-vis the past election. So November 5th was the expected Republican and Trump win. That's what we see here on our follow-up visual of interest rates, long-term 10-year interest rates resurging higher from lower levels, but also tracking back then the Trump Republican win odds. So that was not so much the surprise factor. What was the clear, decisive, and broad win in terms of the red sweep, and the policy market implications in terms of fiscal policy, potential inflation tailwinds, as well as revived animal spirits for equity markets and deregulation friendly environment for Bitcoin. But what all of this means is that the market has just continued to get hot and euphoric into and then after the most important event risk in many years, and arguably even more than that compared to other elections. And so what that will likely lead to is a overheated, overbought situation where those risk proxies that drove up into the election start to unwind into inauguration as part of a profit taking and reality check on the policy rollout to come. And that's something I can add more to in terms of the statistical work that we do here at RW Advisory on election patterns, behavioral sentiment, and markets in general.
Yes, by all means. Why don't you provide some more context to that?
Well, for the equity markets, I mean, probably the best place to begin equities and markets in general is our global ranking model. And this looks at the world in terms of trends over time. And you can see here from left to right, we have trend performance over time, long-term strategic, medium-term tactical, and short-term active. But essentially, if you just think about the calendar dates of the year, yearly, quarterly, and monthly, that's broad brushstrokes what we're measuring here. And what's important is we're not just looking at markets across the world in absolute terms, we're looking at it cross-asset. So we're looking at the relative performance implications. What we see here is, of course, much of the election euphoria peaked out with Bitcoin now testing that psychological glass ceiling at 100,000 K. China, that's been an old story in terms of the post-stimulus policy impact, which led to an upsurge of about 40% in just 2 months. So we'll see if that holds up, but certainly tactically that's been strong, and you can see that in green. But more specifically, you can see the rate, interest rate resurgence in pink there, up and then slightly unwinding more recently. And the USA, yes, it was at new all-time highs, but there was a relative unwind compared to other markets. The rate of change is slower than it looks, and more so when you compare it to the rest of the world. And just lastly, just to highlight gold, which has been everyone's favorite money this year, up 40% from low to high and less so year to date, given the overbought unwind, has also been an inflation gauge as well as a safe haven vehicle. And it had a mini wobble after being so strong for so long, and that's likely a buy on the dip opportunity. So this is a macro market trend overview, highlighting what's best and worst, but also how things have rotated pre and post election. Focusing on your question on equities and S&P 500, it's all part of a three-part headwind that we still believe holds true in equity markets. And probably the most important chart is this one here on momentum being overdone and likely to unwind, partly based on the price pattern. You can see here this is what we term as a 5-wave impulsive Elliott wave pattern, which is a variation of some of the behavioral fractal work that we do. All that means is the markets are strong. It's telling us what we already know, but it's likely overbought profit taking will take place. And if it fails above this resistance trend channel at 6,000 on psychological round number on S&P 500, then rolls back down into the election price gaps, which I'll show on the following chart, and then the support line near 5,700. That's when I strongly encourage everyone watching this discussion to reevaluate. Consider profit taking, look for some downside hedges, no matter what your view is on the upside and how strong the economy might be or exuberant markets are. Do at least consider a tactical view based upon that change in trend. And just to give you the level on the election gap, price gap, as the euphoria picked up, there was an election price gap between 58.70 and 57.80, about 100 points. So that would be the behavioral reversal point for the S&P 500 if we were to reverse back under that, and that would confirm this overheated momentum signal here based on an indicator called DeMark momentum indicator.
Are you concerned about your financial future or think your investments could be doing better? I'm Andrew Brill, one of the hosts here on Wealthion, and I've been there, not sure my money was in the right places. It's why I've gotten help from a financial advisor. Maybe it's time you think more about your financial future or get a second opinion about your investments. We've made that process easy. Simply go to wealthion.com/free to speak with one of Wealthion's registered investment advisors for a free, no obligation portfolio review. Again, that's wealthion.com/free. I'm now less anxious and confident I can achieve the financial goals I've set for me and my family.
So just to summarize a few of your points, you think at or around 6,000 on the S&P, we're going to hit with some resistance and the market might pull back. And when do you think that would happen? Like before year end or in early 2025?
So this is what's less clear on the timing part. Long term, we seem to be developing a overheated, overbought, long overdue market top. And that is likely to confirm more in the first half of next year. And I've got some cycle charts that I can share as a visual reference for everyone that wants to see. Seeing is believing, I know. So for that reason, I've kept it ready for later on. But also to make the point that the short-term tactical has proved more elusive, more challenging than expected. So there are multiple scenarios which we're playing out right now. And I think the most viable one is New Year inauguration, Jan 20, where we start to see more tangible confirmation in the market, either melt up, extension, or overheat, unwind further down. My money's on the latter scenario, but to your question, into inauguration. And just to add, a lot of people in the market are factoring in what typically happens at this time of the year, and that is the year-end rally, otherwise known as the Santa Claus rally for any of those who are feeling festive. But essentially what that is portfolio rebalancing into year-end. And everyone kind of plays the beauty contest and want to make sure they've pulled in the best profits, and so that's when they start to trim back profits and make sure all is good to end the year, and that typically adds to the year-end pattern. But we may or may not see that because we've already had such a strong run this year, plus the euphoria that followed the election event may have muted some of that expected year-end rally. And either way, the analysis suggests that we get a little bit more of a fade into Jan 20 inauguration.
And so once again, I just want to clarify. So on the high end, you think 6,000 to 6,050. And in terms of downside risk, somewhere between 5780 to 5870 on the S&P. Is that correct?
Yes, and it's quite precise levels purely because, I mean, it's good to be on point and data driven, but also because it really is that tight a threshold on the price levels right now. If we get new all-time highs, then it tells us what we already see, a strong market getting stronger. But it doesn't take much for this market to demonstrate overheating and unwinding, which is why we're so strong on this ongoing triple whammy headwind, momentum being one based on wave patterns and various momentum indicators, which are overextended and calling exhaustion now, but also rotation fragility is the second factor. And then the third one is the bearish timing confluence. And just to add, the rotation fragility piece is key because right now one of the strongest things holding this market up is small caps. And while that is good in terms of rotation and more breadth leadership, it's a little bit of a concern in the sense that small caps tends to be more volatile and of late has demonstrated a pump and dump pattern, i.e. we get some great surprises to the upside that fail shortly afterwards and collapse in the opposite direction. And that is often a late stage cycle behavioral pattern, which we should be cautious of. And then, of course, just keeping in mind that the tech concentration that we've had is the biggest on historic records. You can see this chart here developed by Goldman Sachs, but many other investment banks have done similar analysis, just showing the concentration risk on mega cap growth tech as being an ongoing point of concern. Yes, it's a sign of the disruptive opportunity in tech, AI. We know the story, and most people are super bullish on that, including myself. But when the fundamentals and market expectations dislocate from the reality of the price action, it's during moments like that that we typically get a healthy unwind, not least on stocks like Nvidia, which is back at a new all-time highs. But again, it doesn't take much for a stock like that to have an impact, not just on the upside, but also on the downside as part of that high beta two-way factor.
And Ron, the other thing that really stood out to me was the pullback that you're looking for. It's not much of a pullback. It's less than 5%.
Yes, absolutely. So that's purely in terms of clearer signals as to whether this market holds up or not. In terms of a much more bearish risk scenario, certainly the one that we are following is the 2008 global financial crisis. Now, that's going to concern a whole lot of people hearing me say that, and so I do say that carefully. It's not. Let me back up with a disclaimer. It's not a repetition of 08 or any other time in history. It's the pattern rhyme that we're looking at. And so if you look at this chart here, the most important pattern rhyme comparison is what we term as a bullish trap signal, i.e. excessive euphoria on elevated leverage and typically low vol, all flipping the other way when ultimately market consensus gets it wrong. And a lot of that portfolio positioning is forced to sell. It's not a choice. It's a pressure reversal that happens in the market. The same thing happened in 08. We had an all-time high just after a Fed pivot after many years of doing the opposite. And then we had a three-stage corrective pattern: fall, rally, rest of fall. But that middle part of the rally was an all-time high and ultimately a head fake, which then became a bull trap signal. That then led into what became the historical top of 07 into 08. It was a 6 to 12 month topping pattern, but it began in the second half of 1 year and then developed over the first half of another year, which I think is what is likely happening here and now between 2024 going into 2025. And this is typically when everyone is most bullish, most euphoric, and that's the point. It's non-consensus. It's not meant to be in line with everyone's thinking. It's the exact opposite. And for that reason, we get caught out. We're blindsided. And typically, it can be quite a turbulent and volatile changing market environment. And just to add, what would confirm this pattern on S&P 500 right now is a move back through 5670 and then 5400. So not just 5%, 10%, 20%. And of course, if you go back to bear market analogs, 30 to 50% in terms of the big bears. And just to add, one of my educational good, bad, and ugly charts is looking back at bear markets the small ones that are short-lived, such as 87 and 2020 COVID, which recovered way faster than anyone expected. Then the so-called bad during 2000 and 2008. A lot of people allude back to 2000 in terms of the tech concentration risk. And then last but not least, the one that I encourage everyone to have a strong cup of coffee or something even stronger, on the far right, the ugly chart, which is basically sideways roller coaster, volatile market environment, such as the 1970s that included an oil shock and ongoing geopolitical risk premium. And then lastly, of course, the infamous 29 Wall Street peak and crash. Now, our view is that we're likely going to get a hybrid of the bad and the ugly. I'd love to say it's probably going to be good days ahead and summer's going to last for as long as possible. I'm here in the UK and I miss summer, so I'm more than happy to project some of that bias onto the market. But the reality is we have to go through different seasons of the year, and markets do the same. And given that we've had such a strong bull and business market cycle, the autumn and winter season is long overdue. And this time will likely be a hybrid of the two that I just mentioned, partly because of the inflation effect that is building up with all this debt and just general exuberant market moves. So that will need to shake out, reset before a healthy bull market recovery follows.
Yeah, so I have a few questions. You mentioned about this level of euphoria that we have right now, and it is truly mesmerizing watching what this market's doing. So the S&P is up 25% on the year, but there's individual stocks like MicroStrategy that are up 500% on the year. Palantir is up 250% on the year. NVIDIA is up 200% on the year. Like, some of these moves are unbelievable. But you mentioned that you think we might get a slight pullback, say 4 or 5%. But then in the following sentence, you said, well, we might get a significant pullback like we saw during the great financial crisis of 08, 09. How do you go from a very mild pullback to a more extreme one?
Great question. It's worth going back to historical market analogs to help offer pattern guidance as to how markets can do that. 08 is probably the best example. And if I just re-spotlight that pattern analog, it's a 3-stage corrective pattern where we get ebbs and flows. Initially a fall, then a rally, and the rest of the fall. And so the answer to your question, in my mind, and according to our work right now, is that we probably get these short and sharp swings up and down in the early stage reversal pattern development. But once we get the confirmation and the rest of the fall, that typically is either a sideways volatile market or a downward waterfall slide to the tune of some of the historical analogs that we've seen. So there's no one-size-fits-all pattern to how bear market develops. That's unique from one market cycle to another. But it typically is a non-trending, uncertain, and elevated volatile environment. So at the very least, we should prepare for that. Best case, the market continues to overeat some more, and the consensus view continues to project even higher targets on these markets. But I would say the better thing to do alongside that is to consider profit-taking opportunities as well as downside hedges for a change of season as we switch from hot summer to cold winter.
Now, you showed in one of your earlier charts that one of the strongest asset classes out there is Bitcoin. It's up over 100% on the year. And I can't get over the amount of chatter on X relating to Bitcoin. But what are your thoughts here? It's very close to going through 100,000. Does it keep going?
Yeah, I mean, clearly this has been the best performing asset bar none, just because crypto is crypto, and when it goes up, it really it really does, it rockets. And just since the election of November 5, it's up more than 40% just since then. Year to date, even more. Now, and just to add, that's partly down to the crypto deregulation story that is likely to follow a Trump Republican presidency. So there is policy tailwind as to why Bitcoin is strong now in the crypto complex in general. In addition to the halving cycle, and in addition to just a very strong and resilient trend. But nothing goes up in a straight line. If there's one thing I've learned in all these years of studying and trading markets and engaging with clients, is exactly that. So do expect a zigzag behavioral pattern, even in strong markets like crypto. The average volatility, daily average volatility on Bitcoin is 20%. So while it looks super cool on the upside, it can equally surprise on the downside. And I think most prudent crypto and Bitcoin traders know that. That's the price they pay as part of the risk reward profile. But I would caution those that go all in late into the move, because it's just when you least expect it, that the market strong trend gets overheated, unwinds as people take profit, and ultimately as momentum rolls over. And that is true both from the price momentum indicators I'm looking at on Bitcoin and crypto, but also the cycle model that I follow, which suggests that we could get a little bit of mean reversion risk coming into the new year on Bitcoin and most of the risk proxies that ran up into the election. Last thing I would want to encourage is a smart diversification across not just Bitcoin, but also gold. It's otherwise known as BOLD, bold, a blend of the two. And if you just think of an 80-20 allocation, 80% gold, 20% Bitcoin, or less, depending on if you're depending on how supportive you are on either of those markets. But that is a more prudent and better diversification of your risk reward profile across both markets. I wouldn't suggest going all in on crypto now, because I think most of the move is done and we're likely going to get an unwind soon.
And do you have specific targets for the upside and downside?
Yes, so upside, we're at it right now, 100,000. It's a big figure. Celebrate. This is something that 6 digits. We've been, many crypto bulls have been talking about this for some time, and we've hit a milestone. Can it go higher? Yes. And I don't think there'll be too much surprise to the upside, because it's pretty much expected and baked in terms of the crypto dynamics. So certainly I'm happy to speak more to the upside once we get a shakeout. But not before, just because I think the mean reversion risk is probably stronger at this stage. And on that point, I would say at the very least, move back down to the previous all-time high at 73,700 is likely, and potentially lower than that, the 50,000 mark. So we can literally swing the other way and still be demonstrating a healthy bull market correction with a lot more upsides ahead. So if you just think about it, that alone, those levels alone are big enough. Maybe that's a buy on the dip opportunity for crypto for those who maybe are feeling a little bit of FOMO and want more upside ahead, or maybe people who just want to profit take and celebrate the year-end season.
Stan Druckenmiller recently gave an interview, and he said he looks at companies from the bottom up, and he doesn't see any risk to the S&P right now or the NASDAQ and the U.S. economy overall. But he did say the biggest threat to the economy and the markets in 2025 is inflation and a reacceleration of inflation. And he actually compared it to the 1970s, where inflation topped out at 8%. They got it under control, or they thought they had it under control. It pulled back to 3%, but then it just took off again. And you have actually said the same thing, where you thought there was a threat of inflation picking up again. Maybe you can speak to that.
Yes, sure. We're seeing that right here and now. And if we look at our follow-up chart here on inflation resurgence, think 1970s is exactly the analog I'm working on. Again, it's not the exact historical repetition of a macro environment now versus then, because clearly this time is different. But the pattern looks very similar. I've shown that pattern here in the bottom right chart, where you can see outright CPI data in blue here and now versus 1970s in red. And what that shows is, yes, inflation has unwound from a historic high that was made in 2022 when we had the shock in both interest rates and inflation, partly following the geopolitical tensions in Europe vis-a-vis Ukraine, Russia, and the energy implications that followed, plus the general turmoil both there and elsewhere. And for various reasons, inflation unwound, perhaps helped by central bank policy, but there could be a policy mistake ahead because the market, which has the last word, is currently already resurging higher, both in terms of hotter than expected inflation, but actually more specifically inflation expectations. Looking at break-evens, you can just see the top right-hand chart. This is a recent chart which in the updated format shows a rise to the upside, and that has also been the case for the main chart you see here on the left, which is an archive chart. This was correctly predicting the low at 3.5% on US long year rates. We're now at 4 and a bit percent. So that did work out. And as we saw in the opening chart, that was the inflation resurgence seen in break-even rates, long-term rates, as predicted here, which was aligned with the election result and ultimately the structural inflation ahead. Now, the key message here is that not only is inflation resurgence ahead, but it's likely going to be rolling waves of volatility of inflation. So that brings a few behavioral characteristics with it. One, it's disruptive by nature and so difficult to predict. And two, you get a little bit of a rise and fall in inflation. So if and when we do get a market shakeout in euphoric risk markets, that will be disinflationary or deflationary for a period of time. And of course, we might get an unwind in inflation. But at some point in time, perhaps second half of next year and beyond, 2025, second half into 2026, then we get the structural, stronger inflation uptrend to follow, as we did in the 1970s.
So, Ron, inflation is around 3%, give or take. Let's just assume that the numbers the government is telling us is correct. Where do you see inflation going?
So certainly, I mean, we can go much higher than here. It's less about the actual figure; it's more about the rate of change. But to be specific to your question, I mean, we could go into the high digits from here, as we did before. In terms of long-term rates, we could hit back to the 5% threshold, which is the historical level that we've hit many times before, and will likely again. The only question is timing. When that happens and how that happens, but certainly the rate of change will be most important. And just on a more practical and uplifting point in terms of what to do if and when that were to happen, this would be a commodity supercycle story. And this is the one thing that we do have more conviction on in terms of a scenario that is likely to happen. But again, on the timing, that's one thing that we're continuing to watch. This chart here shows a ratio of equities relative to commodities. So when this is up, equities is outperforming the latter. and currently you can see the opposite. Commodities is underperforming equities, and is super overstretched, oversold, undervalued, whichever term resonates for those listening. But the long and short of it is, this is a generational rotation between soft and hard assets, or paper assets and hard assets, I should say. And so the next rotation ahead is for commodities to outperform. And just to preface that, that could be a combination of various scenarios as to how this could play out. One, it could be equities down, commodities sideways or up over time. So it could just be the relative game before the structural outperformance. Two, it could also be the inflation resurgence to come. And three, keep in mind that if the US dollar were to make a peak, which I think it already did in 2022, and will likely weaken into next year, then any further weakness in the dollar, we've had strength so far into and out of the election, but any further weakness below 100 on the dollar index will be commodity bullish, generally speaking, just because of the pricing mechanism on commodities being dollar specific. And so that would provide more tailwind. So think about some of the commodities that are already leading the way right now: precious metals, energy in terms of the stock complex, potentially agri, soft markets to follow, and a story ahead if we get an unwind in equities, more inflation, or weakness in the dollar.
So you mentioned you think the U.S. dollar is it's already topped out and it's going to weaken further. Why?
Yes, so the grand finale chart I have in terms of cross-asset opportunities into 2025 is exactly that. The US dollar king, potentially to lose its crown. I think it already lost part of its crown in 2022, and you can see the top there at that price and time point. We did make the record high back then. We then developed a sideways topping pattern. The chart now is actually testing to the upside. This chart is not updated. So we're at that B level right now in terms of where the dollar index now. But if we were to unwind from those overheated levels back into the 100 psychological level, that would be the main make or break point where I would encourage Wealthion audience members, clients, and students to reassess their dollar exposure, whether it's outright or portfolio related, because that $100 mark, based on the chart, is a decade-long floor in the market that, if broken, would provide more weakness. That's also reflected in the cycle model prediction you see there in the bottom window, which just signals potential two-way volatility over the next few months. And then just to end, what it shows on the far right side, top far right, is how the dollar compares with other currencies in the G10 complex. And it just shows in terms of positioning and valuation that the US dollar has been the outlier all this time. That's partly been because of the policy divergences, which are now narrowing. We now have interest rate differential diminishing after the Fed pivot. We also potentially have a growth slowdown, depending on your viewpoint on US economic growth. Certainly versus the rest of the world, it looks a little bit more sluggish. And I think over time, a slow but steady de-dollarization trend, which could start to prevail even more. Just take a look at what happened recently as an anecdotal story in terms of the BRICS Nations Summit, and look at the policies that they were actually discussing and proposing. It is all part of a longer term trend where the dollar remains king in terms of an important global reserve currency, but instead of a unipolar world, we start to shift into what is deemed a multipolar world. There are other opportunities and other economic centers that start to develop over time. This is being reflected, a big picture macro theme in the chart. And that's why I'm sharing this long-term chart just as a visual, but also as a reference point for people to follow if and when the dollar index breaks this key level.
Okay, I just want to clarify one point. You said inflation is going to reaccelerate in 2025, possibly up to our previous high, which was 9%. And if that does happen, in order to quell that, the government's going to have to, or the Fed's going to have to increase interest rates. Higher interest rates will result in a higher U.S. dollar. How do you reconcile that with this lower dollar scenario?
Great question, and it's also one that I get asked quite regularly in terms of cause effect and correlation. And ultimately, the two parts that I respond with to your question. One, these factors often ebb and flow in their own unique way, and often not in the sequential order that we believe. So I think it'll be a question of timing and the domino effect and how that plays out in hindsight. And then more to the question at hand, this will likely be more the case in terms of inflation resurgence in a structural level once we have a shakeout in the market. And so if you recall that I said, the base case scenario of it likely taking place, inflation resurgence, long-term structural, as happening second half of 2025, more likely into 2026. The bigger question is what happens between now and then. And I think between now and then we get that likely mean reversion risk to the downside on overheated markets like equities and anything else that is overrun. And that's where the Fed or central bank policy risk is more likely because of the likely elevated volatility environment that will follow. But whether inflation happens immediately or later, I think we play the guessing game in the short term, but it becomes more real once we have a risk market shakeout and the whole debt question becomes more front and center.
So I want to ask you about this commodity supercycle, and oil is currently trading around $70 a barrel. Where could oil go to during this supercycle?
Much higher. This can more clearly be seen if you look at oil stocks. Oil stocks have been strong for some time, although clearly they hit a ceiling and unwound. But look at what happened in 2022 when there was last a surge in inflation and rates. Oil stocks surged up higher. We didn't really see it in the underlying crude oil market. Having said that, what's changed now is certainly we have an administration, U.S. administration that is more pro energy, as that new saying being revived, drill baby drill, being clearly supportive for the market in terms of more production. Look at the new appointee that has come into office now that is also very supportive of that market, but in combination, not just policy, in combination with ongoing geopolitical risk. Last time I checked, Europe is still in a conundrum, and we'll see how that plays out. But also the Middle East is still hot. And latest headlines are that there might be an Iranian retaliation strike. Iran being a strong oil producer, that would be disruptive both for oil and the global economy. These risks remain. They're tail risks. We don't know if they play out and if so, when. But certainly that does add a premium to the upside in oil, which from a price dynamic perspective, last third and final factor, is already oversold, range bound at key support. So even from a chart tactical perspective, surprises are likely on the upside in terms of what I just mentioned, policy-friendly environment, vis-a-vis the new administration, geopolitical tension, which remains there. Look at the latest headlines. And then, of course, the chart and tactical overlays, which are oversold at support.
And gold can do very well during an inflationary environment. Do you have a target price for gold?
Yes, absolutely. I mean, certainly we could see further upside into the 3,000 mark. That's the next psychological milestone level to the upside. Also, there's an analog which I don't have ready here, but I can bring on for future discussions. Oil and gold, but more to your question on gold, typically spikes during uncertain and disruptive times. In 1980, gold actually spiked by several $100s in just a few weeks on the back of double-digit inflation as well as geopolitical tensions. That also happened but to a lesser extent in the 1970s. So go back in time and gold really does rocket in a short space of time if uncertainty continues, coupled with further inflationary risks and devaluation of currency. Remember, a big part of the gold trend up is currency devaluation. The money in our pockets are losing value day by day, no matter what we think or believe. And so gold is the hedge reflection of that. And we're now starting to realize that in terms of gold upside this year, 2024, central bank demand alone has been at record levels and clearly also supporting. And we're only just starting to see ETF flows starting to build into the gold market.
Ron, overall, you are concerned about the markets going forward and you think there's risk to the downside. And a lot of the people we interview on this show have been also very concerned in the past year, and they expect a significant pullback in some cases. But yet we haven't seen it. The market just keeps going higher and it keeps climbing this wall of worry. And even myself, when I look at my own finances, for example, in the last 2 years, I've taken a very defensive approach. So I've gone underweight the markets and overweight gold, for example, and it's cost me a lot in terms of performance. But what advice would you give investors on how to achieve this balancing act where you want to be ready for any sort of significant pullback, but at the same time, you still want to benefit from this ever-increasing market?
Great point, and I'm so glad that you brought it back to practical portfolio management terms, which everyone's going to have top of mind in terms of what do we do with our existing capital, both to benefit to the upside, but also manage the inevitable risk to the downside. The best strategy and an educational insight I can share on that is a barbell strategy. That's actually something, a concept accredited to Nassim Taleb, who published on the so-called black swan and tail risk effect in markets. Essentially, it's predicated on continuing to trade the trends that are looking strong in those risk proxies, but with selectivity and where possible profit take, as well as, so that's one side of the so-called barbell. On the other side, hedge downside risk, build in some defensive play, and one strategy I'm a big fan of is scenario plan. Focus on potential scenarios, less on the predictive side, but more on the just scenario plausibility, so that we can be prepared for different types of environments. The best chart I can share on that is just here up on the screen, and this is a lesson that took a while for me to hit home, both for myself and for people that I engage with. Fear beats greed in volatile cycles, and what it shows is how portfolio equity curves perform through different market cycles. The top line is what happens X the worst 10 trading days. risk management, bar none, is the best strategy. The blue line in the middle, which is still positive, but less so, is buy and hold. If you did nothing but just buy and hold, yes, you're going to outperform, but not as much as if you're going to risk manage when it matters. And then lastly, that so-called FOMO effect, fear of missing out, if we miss the best 10 days, is not the worst outcome that we might imagine. It's actually if we try to be too brave for too long during those wild storms, that's more detrimental to the portfolio, and that's what we should keep our eye on. Now, the reality is it's a mix of the two. We want to make money and we want to manage risk as best as we can, both as much as possible, but definitely not to be blindsided by the risk side, particularly in a strong market. And just to add some anecdotal investment wisdom, Warren Buffett famously said, predicting rain doesn't count, building arcs does, therefore risk management hedging matters. But also the gentleman that you alluded to, Stanley Druckenmiller, had a 30-year well-known track record, which turned negative for 1 year in 2000, according to his own words, when he got pinched by the feeling of FOMO and decided to get involved in markets just when it was way too strong. He knew it at the time, but in his own words, he felt the need to play. So learn from the very best, make money whenever possible, but please avoid not getting blindsided by the risk and how important it is, as you can see on this visual performance of X worst and best trading days in the market.
All very good points. And Ron, I want to thank you very much for spending time with us today. And if someone would like to learn more about your services or follow you online, where can they go?
Yes, so I'm available on RW Advisory, our main firm website portal, and of course on social across the board. And for those interested to read free comments on Substack, just type in my name, Ron William. I'm happy to follow up with questions, and I look forward to our next discussion, Jimmy, on Wealthion.
Once again, thank you. Well, I hope you enjoyed that discussion with Ron William. 2025 is just around the corner, and if you have been neglecting your finances this year, consider having a discussion with a Wealthion endorsed financial advisor at wealthion.com/free. Once again, you can find out more information at wealthion.com/free. If you have any suggestions on who else you would like to see on the channel, let us know in the show notes below. We're always looking for new guests. Once again, I want to thank you for being with us today. And if you want to check out more content on Wealthion, check out this video now.